here with the AWA Quarterly Investment Update to 31 March 2020. What a change since my last quarterly report in January. Back then, we saw markets as generally positive, with the major risks being political. I am the first to admit that we didn't see the severity of COVID-19 outbreak, either medically, economically, on the markets, or in our day-to-day lives. Whilst the medical impacts and loss of life due to COVID-19 are horrific, I will focus on the market impacts. To say that markets are struggling to understand and price the impacts of COVID-19 is an understatement. Over the 3 months to 31 March, markets started the year positively, reaching new highs in mid to late February. However, from then on, the US and Australian equity markets fell by approximately 30 to 35%, with their lows reached on 23 March. Since then, however, the US market has rebounded strongly, now being down only 13.2% in US dollar terms. Due to the fall in the Australian dollar, the US market is now down only 3.5% from its peak in Australian dollar terms. The Australian market has rebounded less strongly, still being down 25% as at the 30th of April. A diversified index exposure, with 70% exposure to Australian and international shares, was down 12.3% to the 31 March. So where to from here? There has been a lot of analysis of past market shocks, which we define as falls of more than 25%. And whilst there are limitations in trying to predict the future from past events, there are some points to note. Firstly, almost all past corrections have had 3 main phases. Phase 1, the initial panic. Phase 2, a bear market recovery. And Phase 3, a retesting of previous lows. We currently feel we're in Phase 2. Secondly, typical these shocks take much longer to fully play out than we are currently experiencing, with much longer periods between the peaks and the troughs, interspersed with a number of rallies of varying size. Thirdly, the impact on the real economy, both business and unemployment, is far greater, at least in Australia, than the GFC, whilst the government stimulus package is also greater than the GFC. And finally, we feel that many risks remain. Those include the possibility of multiple spikes in medical cases and deaths. I note that the Spanish flu of 1918 had 3 material spikes within 12 months. Another risk is the delays in commercial quantities of vaccines being available. Finally, or also, delays in global travel and large gatherings will impact economic activity, especially in the travel and the tourism industry. Also, there are delayed impacts on the viability of existing businesses if the lockdown is prolonged, is restarted, or there is a change in consumer behaviours which delays the return to normal spending. At the moment, we remain somewhat sceptical that the current rally will be sustained, with our dominant expectation being that we will see further falls, or possibly more than one, before a sustained recovery kicks in. And so what does this mean for our investors? Firstly, for long-term investors, we know that all other market shocks have ended and equity markets subsequently went on to make new highs. So we fully expect for markets to rebound eventually. Secondly, we have prepared client portfolios with sufficient cash to meet living expenses so we can avoid selling down assets at low valuations. For fully invested clients who are at their target asset allocation, research shows that a hold strategy is far more likely to result in higher, longer-term returns than selling and trying to re-enter the market at lower prices. And finally, for clients with cash to invest, notwithstanding that most markets are considered cheap on a 10-year time frame, we are concerned that markets are not properly pricing in all the bad news, and there are risks of further falls, so we are holding off investing new money for the moment. I have provided a table of indicative market returns for the quarter at the end of the presentation. Finally, if you have any concerns with your portfolio, please call or email Dean, Stella, or myself. Take care.